Hello. Today we're going to look at the solution for assignment number 3 in the International Food Business Finance class. A number of you had difficulties with this and will have learned a lot in the struggle that you had. I apologize for the amount of time some of you spent on it, but thank you for it. In the future, when you get to a point where you're stuck because you don't understand a particular account or how something might have been asked on the question, give me an email and I'll be happy to answer those questions so that you can then continue and not waste a whole lot of time trying to struggle. So let's take a look at this one. It is a challenging question, so let's see how to approach it and how to go about it today. The first step, as always in these types of questions, is to take a look at the transactions that occur in the year that we're hoping to present an ending balance sheet and income statement for. Now this one, you have been given a starting balance sheet. So one of the things to make sure that you do is always check back and forth to the balance sheet to see whether accounts already have a starting balance. Let's start with cash. The starting balance of cash in the balance sheet is $750. Now, go to the first transaction. The owner withdrew $20,000 to buy a truck for personal use. As soon as you see personal use, that's owner's drawings. So we'll have a drawings account here of $20,000. That goes right out of the business, and the cash is reduced by 20. We don't need to know what that cash is used for. We happen to know this time it's a truck, but we just need to know that it's taken out of the business and reduces cash. And it will reduce equity, as we'll calculate near the end. Number 2, building premises continue to be rented at an annual rate of $20,000 during the year. Rent of $15,000 was paid to the owner of the building. So we have rent expense but again, let's go back to the balance sheet and see whether there's anything related to rent on that sheet, and we'll find that rent is part of the prepaid expenses of $5,300. The rent portion is $5,000. So we have a prepaid rent account, which is $5,000. We're going to take that $5,000. Okay, what that means is that the cash has already been paid in the previous year, but the rent hasn't been expensed yet, so we're going to expense that $5,000. So the rent expense is $5,000, offsetting this reduction of $5,000 in the prepaid rent, and that then brings that balance sheet account to zero. And as we know by reading through the question earlier, there's no other rent transaction, so this will be complete as far as the prepaid rent. The rent expense, though, we'll add the $15,000 that was paid during the year. Okay, so there was $15,000 of cash paid to the owner of the building. That decreases our cash and increases our rent expense. Now our rent expense equals $20,000, which is what we were looking for. We're told that rent is $20,000 a year. So there we are. Number 3 deals with fees, and if you look at fees first before we get into anything else, let's notice that they are also on the balance sheet. There's prepaid fees. Okay, so let's look at that. Prepaid fees are $300. Okay, now these fees cover maintenance costs, snow removal, lawn mowing, that sort of thing in a joint building. So it's often that you'll pay rent separate from the fees, and they'll move differently. We're told that during the year starting April 1st to March 31st, there's additional fees of $1,300. Okay, and those fees were paid. So that's cash. Let's get the cash part out of the way. $1,300. Now, look at the period of time we're talking about. The income statement for this business is from January 1st to December 31st. The payment of fees is April 1st to March 31st of the next year. Okay, so when you think of that for a second, that means that these prepaid fees from last year represent the first quarter of this year, January 1st to March 31st. So when we have fees expense, we can add that 300 in here, and then we can reduce prepaid fees by that $300 to balance it out. Those are the two counts for that transaction. Now, what do we include from the $1,300? Well, the $1,300 represents, if we divide it into 4 quarters, the 4 divided by $1,300 is $325. Okay, so the rent starting in April is $325 a month. Now, 3 of those quarters we are going to have in the current year that we're talking about. So those 3 quarters represent $975. 3 months of rent, 3 times this $325. And at the end of the year, we're going to have prepaid rent of $325 that will cover the rent for the first quarter of next year. Okay, so that's a prepaid fee, and we have this $1,300 accounted for by the $975 plus the $325 in cash. Okay. Delivery van. A second delivery van was bought on January the 1st for $13,000. This is expected to be used in the business for 4 years and then sold for $3,000. Let's deal with the purchase first. So delivery van, or let's just call it van number 2, is $13,000. And we paid cash for that. There's no indication that we took out any loans, so we'll assume cash is paid. $13,000. That looks after the purchase off the van. However, don't forget, this is a depreciable asset, so we're going to need to consider the depreciation part of it. And here's how we do that. We have depreciation expense for van number 2. Okay, now we're told in this question that they use straight line depreciation. So the annual depreciation expense is equal to the original cost minus salvage or residual value. Divided by the life expectancy in years. Okay? So we know all this information. We know that it costs $13,000. We know that the expected value at the end of 4 years is $3,000. which is when we would expect to sell it, and it's for 4 years. So the depreciation amount expense for each year is $2,500. And that's what we put in here. Now, as you know, depreciation has nothing to do with cash. It has nothing to do with the cash deal when the van was purchased. That's all looked after. The value of the van is on the balance sheet, and the cash that's been spent comes off the balance sheet. So the account, or the other side of the transaction, where we have depreciation expense, needs to be balanced with something else, and of course that is accumulated depreciation on van number 2, which will be on the balance sheet. So that's $2,500, and that balances. While we're here, and because there's not a separate transaction, it's really an adjustment that we have to make at the end of the year, is the first van, because that van will depreciate also during this year. So we have depreciation expense off van number 1 is $2,500. Okay? And the reason we know that is because if we go to the balance sheet, there's an accumulated depreciation for van number 1 there already of $2,500. That represents the year's depreciation in the first year of business. We know that it's straight line depreciation, so the amount taken off each year is the same. So that van also is coincidentally being depreciated at $2,500. So we have $2,500 depreciation expense, and we have accumulated depreciation for van number 1 off. There's $2,500 already accumulated on the balance sheet, so that's the first $2,500, and we want to now add this $2,500 to make sure that our transactions balance. So the total accumulated depreciation on van number 2 will be $5,000. All right, okay. Wages totaling $36,700 were paid during the year. So let's work on this way. We have wages expense is $36,700. We paid $36,700. And we do have to check the fact that wages might also be reflected on the balance sheet. So let's take a look at that possibility and make those adjustments. So we have accrued expenses that consist of wages, $630. Okay. Now what that means is that these wages have been claimed last year as an expense, but not yet paid. So often it's the case when we're getting paid salaries or wages, we get paid every 2 weeks or every month, and the end of the year falls in between pay periods. So, but what you've accrued, what you have taken on and accrued in the previous year has been claimed as an expense in that year. That's the matching principle. We have to match the expenses that were incurred with the revenues that they help to earn, regardless of when the cash is paid. Now the cash isn't going to be paid till the next year. Okay? So there's $630 off accrued wages on the balance sheet. I think I might have misspoke and referred to this earlier as prepaid. It's not prepaid. In fact, that's the issue. it's accrued and it's been expensed but not paid. So we have $630 of that. Now to bring that to zero, okay, we have paid the $630 now in cash to bring this to zero. So when you think of this, $630 off this $36,700 that we paid for isn't part of wage expense for this year. It was counted last year already. So we're going to subtract that from our wage expense here, the $630. Okay, I hope that's clear. Now finally, at the end of the year, employees had earned $860 of wages for the last week of the year, and it won't be paid until next year. So that $860 is a wage expense for this year, so $860 is added back in here. And accrued wages for the next year are going to be, we have to add that $860 because it's in the same situation this year as the $630 was. So the balance of that account at the end of 2010 is $860. The balance for the wage expense is $36,930. Number 6, electricity bills for the first 3 quarters of the year and $620 for the last quarter of the previous year were paid, totaling $1,820. The bill for the first quarter is $690, but does not have to be paid until $211. So let's again go back to the balance sheet and take a look at whether there's anything there for electricity, and we did. We had accrued electricity according to the balance sheet was $620. Okay, so this is handled the same way as the wages that we talked about already. And so we'll have an electricity expense coming out of this already. Now that first $620 has been accrued. It hasn't yet been paid, but it was an expense from last year, so we'll have to make those adjustments as well as we go along. So electricity bills for the first 3 quarters of the year and $620 for the last quarter of the previous year were paid, and they totaled $820. So let's start with that, like we did before. Sorry, I said 800. It's 1,820. So cash goes down $820. It appears as though electricity expense increases by $1,820. Okay, but we will be adjusting that right off the top with this $620 of accrued, just like we did with wages. So $620, and this goes down $620, so those are the balancing, which brings the accrued now to 0. Okay, now the bill for the last quarter is $690, but does not have to be paid until 2011. So that $690 becomes the accrued electricity expense at the end of the year, and also is part of the electricity expense for this year. So in other words, it's accrued in this year, so it's $690, but we haven't paid cash for it yet. It's separate from that $1,820. Inventories totaling $67,000 were bought on credit. Okay, so inventory. Inventories, we'll take a look at to see if there's inventories on current assets. There is 65,000 starting off. And we bought an additional 67,000. That was all done on credit, and the credit account that for that type of purchase we call accounts payable. So accounts payable, or trade payables. But check first to see whether account payable had, and they do, 22,000. So it was 22,000 already owing on the balance sheet at the start of this year, and now we've just increased that by 67,000. We also bought inventories for cash totaling 8,000. So cash is 8,000 less up here, and we added another 8,000 to the inventory account. Number 9, sales revenue on credit totaled, let me just start another slide over here. Sales revenue on credit totaled 179,000, and the cost of that was 89,000. There's two separate transactions here that and this is often a confusing area. What this means is that we had sales revenue of 179,000. Okay, and that revenue was on credit. Okay? On credit, total 179. So we have accounts receivable that increased 179,000. Check to see what the balance was at the start of the year for receivables. It was 19,600. So 19,600 plus 179,000. That's one part of the transaction. That looks after the sales part, and now we need to, though, we sold, these sales came from inventory, and we need to reflect the cost of those sales. There's a couple of ways to do it, but one way that I think is clear is that the cost of the sales, 89,000, should be put into that account. So cost of goods sold is 89,000. Right? And we have to reduce inventories by 89,000 because inventories are in there at the cost. So we'll reduce inventories by 89,000. Now we made some cash sales. The revenue from those was 54,000, so we're going to increase cash by 54,000. We're going to increase sales revenue by 54,000. And we have to take into account the other part of the transaction, which was the $25,000 cost. So cost of goods sold goes up by 25,000, and the inventories reduce by 25,000. Receipts from trade receivables or accounts receivables totaled 178,000, so that increased our cash 178,000, and it reduces our receivables by 178,000. Purely incidental, I understand that this caused a little bit of concern that whether it's a mistake here because it went up 179,000, now it went down 178. It's just coincidence, really. It's not a mistake, and it's not the fact that we were paying any particular receivables off. It could have been part of the part of the original 19,600. So sorry about that confusion. Receipts, okay, 78, so we've dealt with that. Number 12, payments to trade payables totaled 71,000. So that's a use of cash, 71,000, and accounts payable or trade payables went down 71,000. And finally we have van operating expenses paid, which totaled 16,200. So that's a use of cash again, and operating van operating expense 16,200. Let me just check and make sure I didn't forget the line here. Inventories, I think we're okay. Okay. So the next step is to add all of these up and balance, make sure that our adding is correct. So in terms of cash, we should get a cash balance of 49,730. Okay, that's cash. We have drawings of 20,000, and that's all that's been taken out. Rent expense of 20, so that's a final figure. Prepaid rent is 0. Prepaid fees are, the ending balance is 325. Fees expense is 1275. The van, first van is there. The expenses, we're good here for accumulated depreciation. Yeah, we've balanced all of these ones already. Wage expense 36,930. Accrued wages 860. The accrued electricity is 690. Electricity expense is 1890. Accounts inventory is 26,000. Accounts payable are 18,000. Van operating expense is just the one number of 16,200. Accounts receivable 20,600. Cost of goods sold is 114,000. And total revenue is 233,000. All right, so check your balances on what you've done and what you're working on, and I'm going to now have to erase all this so that I have room to start with the income statement. All right, income statement. Change colors, get tired of black. Okay, so we're just taking our account numbers here. Now I'd like you to make formal titles on these statements, but just for room purposes I'm going to cheat a little on that. Income statement is revenues were 233,000. Cost of goods sold is 114,000 for a gross profit or gross margin of 119,000. The expenses, we had rent of 20,000. Fees 1,275. Depreciation expense for van number 1 was 2,500, and also for van number 2 was 2,500. And yes, you can combine those as far as the reporting goes. Just it makes it a little confusing sometimes for the accumulated depreciation is all. Wages were 36,930. Electricity 1,890, and the van expense was 16,200. So total expenses were 81,295, and for a net income of 37,705. Now, the balance sheet. Let me do a calculation for the balance sheet equity first of all, so we'll have that calculation done. We start out with beginning equity is 76,900. So beginning equity is 76,000. What did I say? 900. 900. Less drawings of 20,000 plus net income of 37,705 for ending equity equal to 94,605. Okay, so we need to remember this number when we get to it on the balance sheet. Let me start with a fresh board again. Balance sheet. Now I asked you to put the balance sheet in the international format. Okay, and that starts with non-current assets. Non-current assets were entirely the vans, so we have vans were 25,000 in total, less accumulated depreciation, which was 7,500. Okay, so for yeah, let's put the net amount here is $17,500. All right, current assets. Current assets, we have prepaid fees. Prepaid fees were $325. We have inventories of 26,000. Trade receivables or accounts payable of 20,600. I'm using abbreviations here, but please resist that. I'm just doing it for space and for demonstration, but please write out these accounts. They're supposed to be written out in full each time you write them in. And finally, cash. Cash is 49,730. Okay, so total current assets, or sorry, total current assets are 96,655, and total assets equal 114,155. Double underline, dollar sign there, dollar sign here. All right, now owner's equity. We just calculated a few minutes ago, 94,605, and we have no non-current liabilities. So current liabilities are trade payables, of 18,000, accrued wages $860, accrued electricity is $690, for a total liabilities, total current and non-current, because we don't have any. Total liabilities are $19,550 for a total of equity plus claims or liabilities is $114,155. Okay. Thank you for your patience. I hope this is useful. When I'm talking to various groups, either in person or by Skype or some method, I will answer any additional questions you may have related to this assignment. Assignment number 4 is a similar question. And remember, please ask if you have a question. Thanks.